Hello, everybody. Welcome to the webinar. It is Wednesday, August 19th, 4 p.m. Pacific time, 5 o'clock for you Mountain Time Zone people, and moving on right down the line. Everybody, you know what time it is. Welcome to the webinar. It's awesome to have you with us. We're really stoked about tonight's webinar. We're going to be talking about real estate, which is amazing, and specifically what goes on in the mind of bankers. How do they decide to approve or deny loans when we want to use leverage or get a mortgage or use financing in our real estate deals? So I'm really psyched to have Creighton and Avram from Solera Bank. Welcome, guys. Thanks so much for being here with us. Yeah, hey. And many of you guys already know the Solera team. I know tons of you already have accounts with Solera. So what we wanted to do is really dig in together and cover some basics about non-recourse lending for the solo 401k, and then also really get into some case studies on what happens when a banker is looking at your loans. So as we get started here, we always like to do our tech check. You should see chat here on the right side of the page. Just go ahead and type your name, where you're from, where you're listening in from. I know we have clients all over the country. And also just make sure that you can see us and that you can hear us. So Avram and Creighton, just go ahead and say hello. And that way we'll make sure, yep, sounds like we can hear you.
Everybody.
All right. Awesome. And everyone out there in TV land, just let us know that you can see us and hear us. And while we're getting started here, you'll see that there's a poll at the bottom of your screen. And we want to know a little bit about you. So have you bought a property in your IRA or your 401k with a non-recourse loan? I know there's tons of real estate investors that we have as clients of Neighbors Group. If you've set up a Checkbook IRA LLC with us, or you've set up a solo 401k with us, and we're really curious to know, have you purchased a property before where you've applied for a non-recourse loan, or do you hold a property in your portfolio on your retirement account that has a non-recourse loan? I can see the votes are starting to come in. Looks like 93% of our listeners or viewers have not yet bought a property with a non-recourse loan. So this is going to be really valuable and actionable content for you guys to learn about how to bring this leverage into your portfolio on certain deals so that you can increase your returns and really grow your retirement nest egg. And awesome. Hey, to everyone that's coming in, Steve and Saba and Brian and Gregory and Tamar and Warren and Doreen and John. And oh my gosh, you guys are great. Saba says you have 5 properties with non-recourse loans. That is so awesome, Saba. I'm so glad. Kim, you're looking to do a non-recourse loan as well. Gregory, hey, great to have you here. Looks like you're shopping for a solo 401k. You're certainly in the right place. We love to provide this education and ongoing materials to clients and just people in the industry. You know, the fun part about having a solo 401k and a Checkbook IRA LLC is actually investing with it. So what we want to do in these educational series are really make this available to you so that you can have really excellent support and you can focus on the fun stuff. So, hey, John from Arkansas. Carolyn, awesome. Great to have you here. Venice, looking to get your first property via this route. Wonderful. Then this is going to have some really great content for you. And gosh, I see you guys are coming from New Jersey and Michigan and Texas and Virginia and Maryland. Tons of people from Maryland, from Florida, from Hawaii, from more in Michigan, Louisiana, Seattle, San Diego. You're all over the place. So it's great to have you here. So let's go ahead and get started. I'm going to leave this poll open, but so far it looks like 100%. The person that was a yes changed to a no. So Saba, you haven't got your vote in yet. That's okay. I know at least Saba's got some non-recourse properties, but we'll leave that poll open so that you guys can let us know a little bit about what's going on in your portfolio. And then we're going to go ahead and dig in. And what I'm going to do first is I have just a couple of slides I want to share with you before I hand it over to Avram and to Creighton so that we can go over just a basic primer of what is a non-recourse loan, how does it work, who is it for, all that good stuff. And then we can hand it over to the experts so that they can take us through some real life examples. So let me go ahead and share my screen here. Give me 30 seconds or maybe less. One moment. All right. Creighton, Avram, can you see my screen?
Yes, we can.
Perfect. And are we both small in the left-hand corner?
We are.
Yes, we
Okay,
are.
great. All right, one moment here. So, as you guys know, we're going to do non-recourse lending and your retirement plan on today's webinar. And of course, just a disclaimer as we get started, even though we are talking about retirement plans and going over case studies, these are for informational and educational purposes only. One of the beautiful things about Checkbook IRA LLCs and solo 401ks is that you're in charge. So make sure you're always doing your thorough due diligence before you get into any deal. And I want to tell you a little bit about our speakers today. We're super excited to have Creighton and Avram with us, both from Solera Bank. Creighton Reed is an executive vice president at Solera Bank. He has been in banking for 13 years and is currently the head of the self-directed retirement division at Solera Bank. And Avram Shabanyan is the business relationship manager at Solera National Bank in their retirement lending department. Avram has over 7 years of experience in banking and lending and is really focused on helping customers reach their financial goals. And I'm Rachel Neighbors with Neighbors Group and Solo401k.com. And so let's go ahead and dig in and talk a little bit about non-recourse lending. So you'll use non-recourse lending when you're buying a property in your retirement plan using financing. In other words, you're buying a property where you're using a mortgage. And typically this mortgage loan is going to come from a bank or a private party. And these are always going to be non-recourse loans. Anytime a retirement plan uses leverage or financing or gets a mortgage, it is a non-recourse loan. And there are some special considerations to cover when it comes to a non-recourse loan. It's different than a normal home loan you might have on your primary residence, for example. One major thing with a non-recourse loan is you're not going to sign a personal guarantee on a property owned by your retirement account, as that would be a prohibited transaction. So you're not putting up any of your own collateral. You're not providing credit check or income stubs like you might have done when you bought your primary residence or even some investment rental properties. Things are a little bit different when a retirement account is the buyer. So as we just covered, no personal guarantee, no credit checks, no income stubs, no income statements. And typically, you're going to be required to put 40 to 50% down because the risk is a little bit higher for the lender. And sometimes these interest rates on non-recourse loans might be a bit higher as well. Remember that that's because in the case of a default, if you stop paying the mortgage payments, the only recourse that the lender has is to foreclose on the property. So the property itself is what's collateralized in a deal. There's no judgment against you personally. They're not garnishing your wages. The only thing the lender can do if there's a default is step in and take that property. To mitigate their risk, they usually are going to want a little bit more down payment, and they're going to want to see that it's cash flowing. So that's a really, I want to now just hand it right over to Avram and to Creighton. I know they've prepared a short presentation for us as well, where we can start to dig in to some of the real life case studies on deals. So Avram, Creighton, whenever you're ready, just go ahead and just begin to share your screen.
All right. Well, let's get this our little thing going. So, can everyone see the start of our PowerPoint?
Not yet. Go ahead and put your mouse over your face, and then press the little computer screen to share your screen.
There we go.
Beautiful. Now? We gotcha.
Perfect.
Awesome. So, I really want to bring you guys into the mindset of of us bankers. What are we thinking about when we see your deals? What deals do we get excited about? What deals are we not excited about? And then also just kind of the difference between the big bank versus the small bank. And
Creighton, one
really
moment.
just to
Come a little closer. I think some people might be having a little trouble hearing you. Come a little closer to the mic so that we can hear you. And then,
okay,
yeah, perfect.
how am I now? Sound
I
good?
think that's better. Everybody sound better? Let us know. Go ahead and keep going, Creighton.
Sure. So with big banks, uh, when you bring your deal to them, every bank is gonna have a box that your deal needs to fit in. With larger banks, that box can get pretty small. And if you've got a funky property or an interesting property or a property that has, maybe some hair on it, um, it at the big bank, it's going to be like the image, over here on the left, and it's not going to fit in their box, and they're not going to want to do it. Most big banks also, actually, most banks in general, don't do non-recourse loans. Um, they don't want to deal with the risk of not having any recourse. At a small bank, we can really mitigate a lot of the different risks. And if one of the criteria is not met, or if there's something that we don't like, then we try and push our bank bag in a different direction so that we can, actually do the loan. So what does our bag look like? Um, I'll throw it out there, but before we get into that, I just want to.
Creighton, I think we still are having a little trouble hearing you. If you can project a little bit more or get closer to the mic, just speak a bit louder.
Okay. So what is our mindset? I mean, why do we want so much money down? Why I feel like a lot of people get very frustrated when they come into lending and they feel like they've got a great deal and they want to know, what are we thinking? And a very important thing for, to understand is what is the biggest upside that we are going to have as bankers in this loan? And the biggest upside that we can get, the best outcome possible for us is that you pay your payments on time and we collect our roughly 5%. That's the biggest upside that that we have. If we had to foreclose on a property and there was a ton of equity, we don't really get to keep any of that equity. So there's no incentive for us to foreclose. We hate foreclosures. What I decided to do is put on this screen the stuff that we as a small bank are more flexible with, or that we have some flexibility, and the parts that we have less flexibility or no flexibility. So our program is a 7-1 ARM. And so basically what that means is that we will amortize your payment out for the 25 years. The payment will be fixed for the first 7 years. And then after that, it goes to an adjustable rate. And a lot of our clients wonder, why do banks do ARMs? Why can't you just fix the rate for 25 years? And the easy answer to that is that we are keeping these loans on our book and we're not selling them on the secondary market. So if you do a mortgage at a bank, that mortgage gets sold off to Fannie and Freddie Mae, and there's people that are willing to sit on that 2, 3, 4% interest rate, for the mortgage.
Wait, one moment, Creighton. Years. Can you repeat that about how you're keeping the loans on your books, but this time lean into the microphone and speak a little bit louder? Because I think that's a really important point for people to hear.
So yeah, these loans, we are going to keep on the bank's books. We're not going to sell these loans. There's no national syndication of these type of loans that we can sell. And because we keep them, the risk that we run is interest rate risk. Because if interest rates go up and our deposits start costing more and more money, there could come a time when our deposits cost more than we're paying out, or than we're earning on the loan interest. And so that's why For most commercial real estate deals, which this is one, it's a commercial real estate deal. The most, the average one is it's fixed for 5 years. You can get a 10-year, you can get a 15-year, but the higher that you go in the fixed rate, the higher your rate's going to be because the risk for the bank is higher. After that 7 years, the rate can be adjusted, and it's based off the New York Times Treasury rate, and it can go up by a maximum of 2 percentage points a year, with a max rate of 6% above your original rate, and then we also have a floor rate of 4.5. All these rates are very standard for commercial loans. For the rate to hit that max rate, interest rates would really have to go crazy. Mortgage rates would have to be at 8 or 9%. So it would have to be pretty crazy. We also do require the escrow for taxes and insurance, and 99% of the time we have to get an appraisal. We actually had a deal yesterday where we weren't going to do an appraisal, but that's because some of the factors over here on the right side of the page were heavily mitigated. And so the areas that we do have some flexibility is the 25-year amortization. We can go down, not necessarily up. We could go up depending on what the debt service coverage is and how much you're going to put down, what the LTV is. Everyone wants to know about rate. How do we calculate what the rate is going to be? Basically, if you just barely meet all of the criteria, then your rate's going to be a little bit higher, or kind of in the middle of this range. If some of these factors on the right are really in your favor and your debt service coverage is 2% instead of 1.25, then we're going to give you a better rate because it's less risky. Some people, let me explain what debt service coverage is. That is the cash flow that you have on your property. And so, an example of that is that if your rent is $1,000 a month that you're collecting, if the payment for the mortgage that we give you on the property is $1,000 a month, then you need to at least collect $1,250 in rent.
So Creighton, I want to jump in with a quick question, and when you answer,
Sure.
You can project and speak loudly. So does that mean that part of what you guys are looking for when you're deciding whether or not to write the loan is you're looking at rental income, right? You want to see the
Yes, we
cash
are.
flows there to approve a loan.
Yes, we are. And we get rent surveys that show what the average rent is in the area. We do have a lot of customers that Airbnb. Airbnb properties tend to collect higher rents than normal rent. But in those situations, unless the Airbnb property has a long history that we can see, we go off of the actual rent survey of the area. For the loan amounts, we will go above $500K. Very rarely will we go below $50K, for a loan amount. And then we do require a 6-month reserve, which that is not as typical in a non-recourse loan, in a loan that's not a non-recourse. The reason why we require that is because if you were unable to rent out your property for a couple of months, you can't come up with that money on your own and make our payment. That the money has to come from your solo 401k or IRA. So we want to make sure that you've got a little bit of cushion in there, so that if there is some transitional period between renters, you'll be able to make the payment on the loan. And then lastly, our max LTV is 65%, and that's for purchases. For cash out refis, we go a little bit lower. but again, that can be mitigated a little bit. We never really go above that, right, Avery?
No, yeah, this time right now we're at 65% max.
Yeah. So let's get into some scenarios here. Scenario, one, this, I saw a couple people that are up in the Seattle area, so they'll know exactly where Mercer Island is.
Yeah.
So why don't you tell us a little bit about this deal?
So this is actually a pretty unique deal because there's an island between Seattle and Bellevue called Mercer Island. And pretty much this area is, all homes are, roughly around over $1 million. I think this is the area where,
Bill Gates doesn't live on Mercer Island, but I think he lives, somewhere.
Yeah. So one interesting thing about this property is that when we go more in depth here in a second, we'll show you guys our underwriting worksheet, kind of what we use internally. We decided to put that out there today on the webinar for all the viewers to see really what does the bank look at in depth, and to give you guys an idea of how we made this deal work when there was some requirements didn't meet our underwriting criteria and how we mitigate that risk. So
let's dive into that and just look at kind of the first kind of spreadsheet that we do, the kind of internal spreadsheet, and why don't you kind of explain some of these things?
So if you kind of go down the line here, it's really a yes or no question, right? And if you see red, or let me rephrase, if you see green, that means it's good. If you see red, we have to mitigate the risk on some basis. So if you look at the property was built after 1950, this property was built in 1947. And then if you look at the debt to service coverage ratio, which Crane just explained, it's at 1.2 instead of 1.25, which is our minimum. So if we go to the next slide, we'll show you guys in depth.
Sorry.
There you go. So let me kind of go over this, and then we can talk a little bit about it here. So if you look at the property value, it's 1.12 million. The customer asked only for a loan of 485. So that automatically translates to 43% loan to value when we go up to 65%. So this right there tells the bank that the borrower, which is the sponsor, and the borrower are going to put more money down. And if we look at the actual available, which means this is what the customer has in his IRA or 401k, was $720,000. Now, if we look here, all these things in yellow that you see, those are subject to change depending on the county or the state we're in. Every closing cost, it just varies. But what I really want to emphasize is for Crane to kind of go a little bit over about this. That gives you really the idea of how the rate and everything works.
Yeah. So because their loan to value is so low, we gave them a little premium on the rate. We were able to
lean in, Creighton. Come in closer.
We were able to look past this 1.2% on the debt service coverage ratio. Because, it really made us feel very comfortable. The other thing that really made us feel comfortable here was after the loan was done, they had $71,000 that they were going to leave in their IRA, which represents 21 payments. And so having that on reserve, it just made us feel very comfortable.
So because they had plenty of cash in their reserves in the retirement plan, and because their LTV was pretty low, they were putting a lot of money down. You lent on this property where otherwise maybe if they wouldn't have had those two factors, it would have maybe been denied. Is that right?
That's correct. So that's pretty much it for this property. Let's go on to the next one. Our next scenario is in Macon, Georgia. It's a 4-unit, and it was built in 1910. So this is kind of opposite end of the spectrum. We were in a very, established area on Mercer Island, and so let's dive into. This client had $138,000 in their IRA or in their 401k, and I'll turn it over to you, Abram.
Yeah, so some things I want to kind of talk about here we kind of talked on Mercer Island, right? You see here the minimum requirement again is 1.25. That really never changes. But if we look at the customer's return on investment, essentially her NOI or debt to service coverage is 2 to 1. So essentially the only really thing that we saw in this property was it was built in 1950, but before 1950, I apologize. But the cool thing about this property is that it's actually been remodeled close to 4 times and was lastly remodeled in 2014. So pretty much the whole inside was remodeled. And I kind of want to go into the spreadsheet here for a second because this deal is a little bit more unique because he has what I like to call other costs associated with it. So if we look again through the spreadsheet here for a second, purchase value was, or purchase price was $222,500. The customer want to take max LTV, which accumulates to $144,625. And if we, again, all this cost is here that is associated. And then if we look right here on the corner, again, the really nice part is the rate was flat 5. The monthly rent was $3,075, and all of her expenses, including taxes, insurance, property management fee, and HOA, accumulated to about $1,475. So if you take these values, pretty much think of it this way: for every dollar she spends, she brings $2.09 in returns. So this property was really, for us, was what we call a perfect property, right? Where it's a great cash flow. The property has 6 months reserve. On top of that, she has plenty of cash left in the IRA that she can use for retirement. And we did max LTV and also gave her a discount on the rate, of course, because of how well it cash flows.
All right, let's go to our last scenario. Our last scenario was in Pagosa Springs, Colorado. Really unique property. Why don't you tell us a little bit about this property?
Yeah, so this property is very unique because, obviously it's not in a city. It's a very like a mountain cabin atmosphere. So this home owns a single family home, which is a main house. On top of that, it has a cabin and a 2-story garage.
So, what was the client hoping to do with this? Are they going to rent it out? Are they going to Airbnb it?
Well, that's a great question. So this client had actually a couple of strategies. He was going to rent out the main house, and then the cabin, he was going to Airbnb it because obviously it's in the mountain area, so plenty of room for Airbnb revenue. And on top of that, the 2-story garage, he's actually going to remodel to make it a office space for anybody that wants to kind of rent it out in that area. So it's a pretty unique strategy that he had.
Awesome. Let's look at the underwriting criteria. It looks like everything was pretty in line.
Yeah, all greens.
And then, so we gave them 5% as well. Why did we do that?
So we gave him 5%. If we look at the really key element here at 5% was we knew that he was going to have multiple sources, multiple avenues of revenue coming in. But if we look here, his max LTV, which is 65%, which is max that we go to. And on top of that, he's pretty close to the debt to service coverage ratio. But we felt pretty comfortable because we knew that the property has kind of 3 ways to bring income. And he was being really conservative with the 3,000 when we projected to be around 4,400. What we did is we kind of underwrote it based on what he projected, and it's still cash flow. So we told him, hey, we'll give you a discount on the rate because it cash flow very well. So essentially, it's really kind of we look at all the numbers and we look at the property in general to make sure it meets our criteria, but at the same time, we're taking care of our customers who are acquiring about non-recourse lending.
Yeah. So let's talk about some common reasons for loan declines. Why don't you go through this?
So we do a small credit check, essentially to make sure there's no bankruptcy, delinquency, foreclosure in the last 7 years. The reason why we do that is essentially we want to make sure that the bank is protected because these are non-recourse. Investment property that it does not cash flow at 1.25. This is like a 50-50. Obviously, we just went over a deal that we actually did close. But in order for us to be comfortable with a lower than 1.25, we would have to have a lower LTV and a bigger reserve requirement. Usually that's how we mitigate that. Investment property that's not habitable to condition to live, so it needs major repairs. There's issues with the property where somebody actually cannot live there because it's not in livable condition.
So Abram, if someone does need to, some lending to fix that up, are we the lender for them?
No, unfortunately, we don't do fix and flips or fix and long-term holds. We kind of come in when the property is ready to be remodeled and ready to be put into rental use.
Okay. And then the last one. Okay.
Yeah, insufficient funds. If you don't have enough money in the IRA to buy the property, there's really nowhere for us to go around that, and that's because the rules with the IRS.
Yeah. Here's some other requirements and exclusions that we have. We have to be, in first position. We don't want to be in a junior, lonely spot. Title insurance is required. The payments must be set by autopay, from a Solera account. Going more into what Abram said, the property does need to be tenant ready. I mean, if it needs some paint, a new carpet, that's fine. But major repairs, it just puts a lot of risk on the bank side. Currently, we're only doing 1 to 4 families. We will go larger on an exception basis, but that 1 to 4 family area is just it's a safer spot for the bank. Yeah. It must have all utilities. That seems like a no-brainer, but we have gotten some interesting deals that have come our way that are just in remote areas, or they're really funky cabins, and it's just not something that we're willing to do. Can you go into this last one?
Yeah, so properties used for like business purpose, such as nursing home, care, and there's a variety of other ways that the property can be used. It's not really eligible for financing. So for example, let's say you bought a house, let's say a nursing home. Usually a nursing home is required to be inside renovated to code with the state. And because it's substantial amount of money to remodel according to the code and the policies and procedure according to the state, it becomes really for us kind of a spot where it's not a rental property now, it's a business purpose property. So due to that purposes and a lot of involvement there, we just kind of step away from there. Yeah. We don't go into that space at all. So we're like to the 1 to 4 family turnkey properties or tenant ready properties. Mm-hmm. That's what we help our clients, reach their real estate investment goals.
Awesome. And we've already got some questions rolling in here. So I want to get to those in a moment, and I'm going to make my head a little bit small. So you should be able to still see me, but here I am, just miniaturized down in the corner. And first of all, I do want to just let people know, I know tons of you who are on the webinar with us this evening, you already have a Solera account. If you are new to us or you haven't yet established just your regular bank account for your solo 401k or your IRA LLC with us, I would strongly recommend reaching out to Solera. They, as you can see, they clearly have tons of experience in this space, and they have dedicated solo 401k departments. So they know how to open the account and be able to service the account, where we've heard some horror stories over the years of people having issues with banks that don't understand how to deal with or respect or understand solo 401ks. So there's a link that's at the bottom of the page here. I'll put it into the chat as well. If you have questions about bank accounts, and if you want to learn a little bit more about their loans, then I've got that button down at the bottom, and I also put a link in the chat. Fill out that contact form so that you can connect with the Solera team and they can learn a little bit more about your situation. And now, guys, we've got some really good questions coming in. So the first one comes from Rami. He says, do you offer loans for a mobile home on private land, not a mobile home in a park?
So we have done, there's a lot of different, it depends if it's fixed to the property. It depends on where it is.
How it's zoned.
Yeah, how it's zoned. We have done a bunch of modular homes.
Yeah.
We've done some manufactureds. We even outside of the non-recourse area, we've done some mobile home parks.
Yeah.
And so honestly, we just have to look at it.
Yeah, it's a case by case, I would say. So definitely be just to kind of get more information on it and understand.
So what would help its case probably is if it was in a metropolitan area. If it's a mobile home on its own land in the middle of Kansas, that's tough because one of the things that we look at is if we did have to foreclose, how easy would it be to liquidate this? And so if it's in a metropolitan area, very easy. There's lots of buyers in metropolitan areas. If it's in a rural location, it's more difficult.
Yeah.
So. Yeah.
Awesome. Cool. So Rami, if you would like to discuss this deal, then I would recommend filling out that contact form. So that way Avram can look at the numbers for you and you guys can really dig in and see if it might be a good fit. Next question, also from Rami. And I think Alan, you posted this as well. Is there a prepayment penalty clause?
No.
Yep.
Yeah. So, and I just want to brag about this a little bit. We are a meat and potatoes bank. We make money off of interest. We're not, huge on fees. I think, last month in total, we collected maybe $90 in overdraft fees. We're just, kind of not into the fees. And so we don't really have a prepayment. So.
Great. Okay. The next question, I think this is from Randy, says, do you do non-recourse loans into an LLC instead of a 401k with similar terms and requirements? And Randy, I'm going to actually ask you to jump in and clarify this a little bit. I know that Solera does IRA LLC loans, and Creighton, you also do 401k with special purpose LLC loans as well, right? So as long as the member or owner of the LLC is a retirement plan, then you can write the loan for the LLC.
That is correct.
Perfect. Randy, if you had a different LLC structure in mind, let us know. Otherwise, the answer is yes. If it's an IRA LLC or a 401k with an LLC, then they would do the loans there as well. And are those with similar terms and requirements, guys? It doesn't matter if it's a 401k or an IRA LLC. What you're doing is looking at the deal, right?
Yes. Yeah. Still the same loan criteria. So.
Okay. Awesome. The next question comes from Sean. Sean says, what credit report are you referring to? I think this is with respect to, Avram, when you were talking about sometimes pulling credit for the potential borrower.
TransUnion, Equifax, I think so.
Yeah. So I think we do Equifax and TransUnion. Yeah. And what we're looking for is, something that really stands out. We're not really looking at credit score or your debt ratio. What we're looking for is foreclosures. Is there a pattern or a history there of some mismanagement of really big loans.
Yeah.
So.
Really, that is just to look at those main factors that I kind of pointed in our PowerPoint. So.
Okay. Perfect. That's very helpful. And I do see a follow-up here from Randy. He said, I meant not associated with a retirement plan. So this is a great question, guys. Would you consider writing a non-recourse loan? Let's say somebody just has an LLC funded with their personal funds, but they want to invest through the LLC. Would you write a non-recourse loan for that LLC property, even though there's no retirement funds involved?
No.
Yeah.
No. Okay.
No.
And so there's a lot of psychology behind this, and there actually is a lot of psychology behind lending in general, and some of the rules that are out there. If outside of your retirement account, if you lose your shirt on a property, it's going to hurt, right? If it's inside of your retirement account, the likelihood of people letting that property go is lower, because in a retirement account, you're talking about your future. You're talking about,
savings, life savings.
your life savings, and so your willingness to let that go is diminished, and so the risk is lower towards the bank. It's the same reason why why with a commercial property or a rental property outside of of a of a retirement account, that every other bank requires that you put more money down than on your primary residence, because on your primary residence you're not as willing to walk away from it, and you're not as willing to walk away from your retirement property as well.
That's really good. I think that's a really salient point. That's helpful. Another question from Sean: what specific options does Solera offer for refinancing after the 7/1 ARM? Do you offer another ARM or fixed for 15 to 20 years?
So we'll do another 7/1 ARM, and at whatever the rate is at the time, we probably would. The fee would be lower if a fee at all. We're not, the purpose for the fee up front is to pay all of our underwriting staff, but it's also to mitigate the risk if someone pays off early. And so yeah,
we might potentially have other terms in that we just can't foresee the future, right? Yeah. But 7 years from now is a pretty long time. So as of right now, that's the term we have, but maybe in the future we might have something else.
The other thing to think about, though, is that you're already putting 30 or 40% down. After that 7 years, with appreciation and everything, I mean, your loan to value is
you've made a big chunk. Yeah, you've made a big principal reduction.
Yeah.
Yes, exactly.
And so, even at that 7 year mark, if the rate does go up because rates have gone up, your payment might actually be lower because it's going to re-amortize at the loan at the new loan balance, and so yeah.
Awesome. Next question that we have, and these are really great questions, guys. We really, really love these, so keep them coming. Okay, next question looks like comes from Charles. If the 401k account doesn't have enough funds, are other sources of funding like a Roth IRA or personal savings allowed? If you want me to jump in and help with this one, I'm happy to as well. Yeah. So, Charles, what you're asking about essentially is partnering or using other funds as a reserve. And I think, SG, you had the same question in the comments. Can you use non-IRA or 401k funds to show reserves? So the deal needs to stand on its own in the retirement plan that's doing the investing. If you're getting a loan with a solo 401k, the solo 401k must have sufficient funds for the entire down payment and closing costs and to be able to cover the cash reserves. If you're doing the deal with your Roth IRA LLC, your Roth IRA has to have sufficient funds for the down payment, the closing costs, and the cash reserves. So each deal is going to stand on its own. We do not recommend that you partner with your 401k and your Roth IRA. That is a gray area at best, a prohibited transaction at worst. So let your retirement account stand on its own for that deal. And then Creighton and Avram, am I correct when SG is asking, can you show non-IRA or 401k funds as reserves? That would be a no, right? Because you can't just put money from your retirement plan to cover any overage or any missing funds. You can't just put money from your personal bank account into the 401k or the IRA. So non-retirement funds are not adequate for your reserves. Let everything be in the plan that's doing the investing. Would you say that's a fair answer?
Yes. Great way to put that.
Okay, cool. So Daniel says, are well and septic okay for utilities?
So, well, in a lot of part of the countries, well water is fine and septic as well. So yes.
Yes. We just asked when was it maintenance. That's it.
Yeah.
That's really the only thing.
Got it. Perfect. Okay, so next question we have is from Wesley. Will you do a refinance of multiple properties consolidated under one jumbo loan? Example, 1.4 million loaned at 50% LTV. Fees rolled into the loan, leaving approximately 6 to 700,000 in the solo 401k. A total value of properties is approximately 2.8.
Absolutely.
Yeah.
Yes. I mean, that's
From these numbers here, I mean, obviously, Wesley, and for everybody that has sort of specific deals that you're thinking about, make sure you click that button below or fill out, click on the little link in the chat. Fill out that contact form. The best thing to do, we're covering as much as we can on a webinar in a public forum, but really the best thing to do is have Abram dig into those numbers with you so that we can actually, or so he can actually look at the scenario, look at the cash flow that's coming in, and really make an educated decision for the two of you guys together.
So we actually have a lot of experience with those type of roll-up loans. And something that people don't think about is, let's say you've got 3 to 5 properties that's wrapped up into one big loan. What happens if I sell one of the properties? Do I need to redo the loan? What happens if I want to do like a cash out later? I mean, like how do these properties affect each other inside of that that big loan? And so we've been doing that for a long time outside of non-recourse lending. And so, we've got the mechanisms to be able to rewrite the loan if you were to sell one property and get it figured out.
Awesome. I think this next question is going to be very similar. So Alan says, I have 11 houses that I've bought, renovated, and put into rental. In a year and a half, I should have 20 individual homes renovated and fully rented. If I want to borrow for new properties that also need renovations, could I do a refi on some of the properties already generating revenue to get around your hesitance to loan for properties that would need renos before being put online?
Yes, and I'm going to turn something over to Abram to explain something. When we do cash outs, we really want to look, so the appraised value or the value that we're going to use for that cash out refi is going to vary, and it might not be the actual appraised value. So can you kind of go into that and then why we use the value that we actually use?
So it's a great point and a great question. So to answer number one, the question that was asked, what if the property is 1.5 years, which we consider 1 year or 2 year, 3 year seasoning is what we call it. So when we have a house that's owned for only below 3 years, we usually always look at total acquisition cost, which is what you bought it for, purchase price, plus what's documented upgrades, which is your remodel cost, and that equals your total acquisition, and we usually go up to 60%. So kind of what Crane just brought up, that's called appraised value versus total acquisition value. So what did you put into the property versus what did it actually appraise? And the philosophy behind why banks such as Solera National Bank that do non-recourse loans, why we don't use the appraised value is because number one is if we're going to cash out based on the appraised value, let's just say you got it at a deal. You bought it at 40% a discount, you put it in, well, now you automatically gained 40%. That is very well for you. But for the bank, it's a big risk if I lend you now that money and fully cash you out, because now you don't have anything invested in the deal. No skin in the game is what we like to say.
Yeah, so as lenders, we want to make sure that you've got some skin in the game. And if you have some skin in the game, then you're less likely to walk away from a property if there's ever an issue.
Because if I fully cash you out, if something happened, then you can just walk away, right? But if I only cash out what you put into it, now you have something in the property.
So it's not like a refi cash out on like your primary residence or whatever, where you're sucking it back down to maybe only 10% equity in the deal. Even when you're doing a refi cash out, you're going down to like 40% or something, so that there's still risk mitigation for you as the lender. And like you were saying, the borrower also, like, they've still got 40% equity in the property. They're not going to just walk away from it.
Yeah. So, but I mean, the intent of his question was, could I use the equity in those properties to go and do rehab on other properties? Absolutely.
Yeah. What we would do is, to kind of piggyback off Crane, what we would do is we would do a cash out refinance and he will use that money in his account. And now he use that cash that he just refinanced to go do the rehabs and purchase the properties. And then he can kind of do that cycle over and over and over,
Yeah.
So it's definitely an option. Would love to talk.
Yeah, definitely. I think, Alan, go ahead and click that button in the bottom of the page here, set up a call with Avram, so that way you guys can dig into it a little bit more. Okay, and I know we've got a lot of questions. We'll try to get through as many as we can in the next 10 minutes or so. James says, any special requirements for short-term rentals or Airbnb properties?
Just what we mentioned earlier, that we're going to do the rent survey, and typically we have the appraiser do that, and so that's kind of what we're going to base the rent off of. Unless there's with some Airbnb properties that have been doing it for years, there's a nice
historic data.
Historic data. But if there's not that, if you're going to buy a property that's never been Airbnb'd, then we're going to go off of the rent survey.
Okay, awesome. Sean says, back to the credit report question, just to clarify, is a personal credit report pulled on the trustee of the 401k trust requesting the loan? Yes. Because you're the signer on your for the 401k.
You're the sponsor,
trustee.
Yeah.
Yep. Perfect. Okay. Another question from Sean. What platform are you using to determine average rental rates in an area?
So, I kind of just mentioned that. So we go off of most appraisers will do a
rent data.
Yeah, a rental survey.
Yeah.
And so that's what we use for most. And then, there's some other resources out there. We don't use Zillow, but we look at it just to see kind of what the average is there.
Yeah, Zillow, Redfin, Realtor, Cold Bankers, Realtor Group. I mean, a lot of them would have some data.
Yeah, we use those more as just kind of a gut check to make sure that what the appraiser sent us is in the ballpark of what they're saying.
Yeah.
Cool. And as a follow-up from Sean, he said, just needed to know if my credit will get dinged. I don't think this type of a credit report pull dings your credit.
Yeah, I think it's it's a soft pull, and but we can go and confirm that.
Yeah.
So yeah, Sean, if you have a deal that you're thinking about, then setting up a call with Avram, then you guys will be able to confirm. I don't think it will ding the credit, but they'll be able to confirm that for you. Tannen says, if I have a property that is not currently mortgaged, can I take a non-recourse loan on the property now? Or is that unallowed because I would have to sell the property from myself individually to my solo 401k? Okay, I'm going to jump in on this one, Tannen, for you. So you guys have heard me say this if you've been on our 5 ways to invest in real estate with the solo 401k or the CARES Act webinars that we've been doing or contributions webinar. I always say a good rule to remember is if your retirement money is in a deal, you aren't. So what this means is if you have purchased a property with your solo 401k or with your IRA LLC, you cannot have personal possession of that property. You can't live in that property. You can't do the work on that property. You can't pay for that property. The reverse is also true. If you own a rental property in your personal portfolio, or maybe through an investment LLC that's seeded with non-retirement funds, you cannot sell that property to your retirement plan, and you can't put 401k money into that deal. So remember, if your retirement funds are in a deal, you aren't. And if you're in a deal, then your 401k or your IRA isn't. So keep them separate. Yeah, that's that for that one. Okay. Next, we've got Yvonne. Yvonne says, what qualifies or how do I know that a real estate transaction is qualified for a solo 401k? Yvonne, this is definitely a question that you'll want to ask us. We have a lot of articles and support and ongoing webinars just like this to help educate you, make you feel really empowered when you're using your solo 401k or your IRA. We have a whole bunch of information on prohibited transactions. We created and invented something called the prohibited transaction checker, where you can log the details of your deal, and our checker will automatically spit out if you've done any red flags and tell you how to fix them. So I think that's a question. If you're already a client of Neighbors Group, make sure you're sending the idea that you have for that deal over to us, and then we're happy to walk you through that and see if it's a deal that can go in the solo 401k. And then if that deal needs a non-recourse loan or needs leverage, then contacting someone like Solera is a really great idea to see if it's a good fit for leverage on that property. Okay, next question we have, and we're just going to do a couple more here, guys. We're coming up to the end of our time here. So Carolyn and Mike say, do you offer loans on land with the plan to build 1 to 2 small homes? Construction loans. Thoughts?
No.
Yeah.
So the short story is, in a downturn in an economy, the value of land actually goes to almost zero. And so if there's no improved property on it, and so we don't want to, have a loan on land, even if it's only for a couple months, because if the economy all of a sudden dies, then that value it goes away.
Especially now, I think both investors and lenders, we're treading carefully. I mean, I think it's, a shock to no one that nobody knows what's going on right now with the economy, what's going to happen in the next few months. So both as investors and as lenders, we want to identify opportunities where we can really grow our assets, but we also want to have our eyes open when it comes to risk mitigation. So cool. Thank you. Roman says, is there a limitation on the number of loans under the same 401k account? So you, as long as the property is cash flowing, the LTV is there, the reserves are there, then you're not going to say, oh, you already have 2 loans out, you're not allowed to have number 3. Awesome.
The only thing that we have a limit on is, and this is with any bank, there is a limit that we will, of a dollar amount that we will lend to either one person or one entity, and our limit is around $5 or $6 million.
Fair enough. Okay, Saba says, why is the loan limited to 4 units and not more, as long as it's non-recourse?
Sure. So that comes down back to the banker's mindset of, if we have to liquidate this property, how easy is it to liquidate? 1 to 4 family is just a standard property out there. There's a ton of different investors that want to buy 1 to 4 families. There's a limited or a more limited amount that will go above that. And banks most of them do, this 1 to 4. Above that, a bunch of banks do it above it, but it's tougher to get financing because the risk is a little bit higher, because the market for those properties is smaller. The amount of people that can actually buy those properties is less than the amount that can buy 1 to 4 family. We will do above it, but it's totally on a case-by-case situation.
Yeah.
So I know that we have a lot of apartment syndicators, for example, that we work with, and that like to have us set up solo 401ks and IRA LLCs for their investors. So it may still be worth it for, if someone has a syndication in mind, to reach out to you on a case-by-case basis to see if the numbers are there to support the deal and if it makes sense. Is that fair?
Yeah. In talking about condos, one thing that banks really look at is the occupancy or the owner occupancy rate of a condo complex. So, back in 2007, there was all these huge condos built in Las Vegas, right? And they were only like 10%
zero
owned by people that actually live there. Yeah.
Yeah.
And so, there's a bunch of requirements there. I mean, we want to see over 50% owner occupied. We don't want it all rentals because that makes it more, it makes the whole property more risky. And so, I mean, it kind of comes back to a case by case situation.
Cool. Awesome. Okay, so we've got one more question here that we will get to, and this one comes from Warren. Warren says, can a combination of retirement funds be used as long as I don't include my personal funds? I'll jump in and help with this one, Warren. Again, this is going to come back to you're a disqualified person in the eyes of the IRS. So your IRA and your 401k should really not transact together. If you're a solo 401k client with us, then just reach out to us and we'll help you do the rollover. It's better to be able to consolidate all of your accounts into your solo 401k or into your IRA LLC structure. That way you have a larger pool of funds to draw from for your investment, because you really don't want to partner even with your IRA or your 401k together on a deal. Moreover, you really don't want to partner or mix different tax classified funds in one investment. You can. It's fine to put in some money from your Roth 401k, some money from your pre-tax 401k. But just keep in mind that with a solo 401k and a Checkbook IRA LLC, you're the record keeper, you're the administrator, and that means it's your responsibility to keep track of the records of the money coming in, going out, and also keeping track of which percentages are taxable if you're using pre-tax or which are tax-free if you're using Roth. If at all possible, make things easy on yourself. Stick to one tax classification. You're buying it with Roth money, you're buying it with pre-tax money, and stick to one retirement account. Do the deal with your solo 401k, do the deal with your IRA LLC or your Roth IRA LLC or your Roth 401k. That's what's certainly going to be easiest. So, okay, now how do I make it so we're both on the screen at the same time? I'm going to try to figure it out. I don't know if I can, but I'm going to try.
By the way, great questions, everyone.
Yeah, very great questions.
Yeah, this was really awesome. I'm really glad that you were able to join us today, guys. It's so valuable to really hear the banker's perspective, because I know that for many of us, it's kind of like a black hole of wondering, what is a banker really thinking when I'm sending them the documents or when I'm just kind of doing cold outreach, trying to find someone to lend on my property. So it's really, really helpful for us as investors to know what your criteria are, what you're looking for, and also what's a deal killer. That saves a lot of time. And remember, if you're an investor and you're putting together your portfolio and you're out there scouting for deals, now you have tools in your tool belt. You know what these bankers are looking for. So bankers, close your ears. You know what they're looking for. So you know how to find the deals that they're going to lend on. And that's what can help grow your portfolio even more. So thank you guys so much for joining us. Thank you, Avram. Thank you, Creighton, for being here. If you guys have a deal in mind or one that you're considering, I strongly recommend reach out to the Solera team. They're awesome. If you don't have a bank account open yet for your solo 401k or your IRA LLC, reach out to them as well. We talk to the Solera team like pretty much every day. So it's really fun. And we're happy to work together with you guys to make sure that you're well supported. So thanks for joining us, everyone, and have a great evening.
Thank you, everybody.
See you, everyone.